Good day to everyone. Thank you for joining us. This is your September market update with myself, Jacob Chaparro, and my trusted colleague, Pablo Marul. Today, we're going to discuss a couple of technical things that we want to take a little bit of time to go down the historical path, if you will, to understand where the potential market correction could be looming. We're going to give you some really good data to take back. Of course, historical data only helps us. It doesn't drive our decision making here, and it shouldn't for you. So we'll discuss that to give you some intel as we are now 18 months and counting from the last correction. We also want to talk about a little personal finance for you and finish off by setting some expectation as we enter the last quarter here of the year, finish off the month of September. So Pablo, welcome to this month's update. How are you doing?
Very good. Thank you for asking, Jacob, and very happy to share some of our proprietary research. And if you want, we can go straight to some of the data that it will be very helpful for many people.
Yeah. Before we do that, just want to remind everyone to please subscribe to our channel. Feel free to leave us a comment. Leave us a comment so that we can talk about things that you also want to hear. Feel free to subscribe, follow us on Instagram, on LinkedIn. We're happy to hear from you and actually discuss things that you're curious about. So yes, Pablo, let's transition into our first topic, which is the correction. So what can you tell us about where we stand and then what type of proprietary research we've done to help us understand to make better investment decisions?
Very good. Okay, so basically the definition of correction is any decline of more than 10%. And we have analyzed any correction since 1970, actually 1950, until today. And here in the first graph, we're going to show you what happened the last three corrections. For instance, just to have an idea in a graph, which is very helpful, of what is a correction. So the first one, in 2018, that was around 10%. Then in any correction after you have an up, the market grew a lot. And then you have a second correction in at the end of 2019. So as you see, for instance, the last correction technically was on COVID last year in March 2020 was actually correction and a crash, because a crash is more than 20%. But if you see that since the last correction until today, it has not happened a correction, and the market has grown 106%.
Yeah.
So that's kind of one part that is interesting. Think that this correction is good because after a correction, you have a great upside potential.
Yeah, and I, looking at the graph here of the last sell-off we talked about a crash, right? And in fact, what we're going to do here, let's show our viewers these technical meanings where you have a reduction in the market less than 10%, it's a sell-off. If it's between 10 and 20, it's considered a correction. 20+% is considered a bear market, and so on and so forth. You'll see that there. But to pivot back to this chart here, fastest recovery ever of the S&P 500 on record. We just surpassed this past month the market doubling as we show the graph once again, and that naturally should give us a little bit of warning to understand where we're at. And Pablo said it best, corrections aren't a bad thing necessarily, because it gives the ability to have periods of readjustment, which is always good, realistic valuations, which is really good. And the reason it's really good is it prevents us from having these really steep corrections or market crashes. And that's important to us all with our wealth, because slow and steady typically wins the race. If we're able to get consistent returns, ultimately that leads us to more of dollars in our bank accounts, in our 401ks, and our IRAs.
And that's, you say it very well. And we analyze all these corrections. Now, what we found out is that usually the gain, the blue arrow, usually in average, the median percentage gain is 38% from the low to the new peak, no? And these last, all positive return, they last 230 business days, which is approximately 11 months. So that's kind of if you can call it time between corrections, no? And when a correction happens, the median losses are 16%. So just, be aware of that. And the losses, they last between 70 business days, which is 3 months and a half in a median time. So this is important to consider. So it's hard to know when it's going to happen, but there are always also many reasons, many explanations, if you want to call it, of why this correction happened. But just to be aware, it's overdue because the last one was in March 2020. The median is 11 months, and also the upside potential so far is 106%, and the median in the past has been 38%. So in many ways, let's be aware.
That's the thing. We don't want to get extremely technical here, but we do want to provide you hopefully really high level data to give you a sense of where we're at, so that you can either readjust your investments. I know for us and our clients, the risk to reward dynamic, as we love to talk about here in our market updates, is something that you need to think about at this point, right? And again, to echo the thought of historical information not being the driver in your decision making, but it definitely should have a big influence. And as Pablo mentioned, if we pull the graph up again here, every time we have a correction, 10% sell-off or more, it typically is 38% in gains. Currently, we're at 108%, so almost approaching 3 times more of the average. It's incredible. Typically, it lasts 11 months. In comparison to our present environment, we're at 18 months plus. So from a purely historical statistical viewpoint, we are overdue for that. Now, if you really are into the markets and want to research, there definitely is. These are averages we're talking about. So there definitely has been periods in time with the market hasn't seen a correction for a couple of years, 3-4 years in some situations. So is it out of the picture to be able to see the market to continue to propel? History tells us, yeah. And that's where you want to decide how you want to alter your portfolio, because right now, I think a great takeaway is the risk to reward dynamic is starting to kind of get top heavy. Another way to put it is right now, to get gains, you're going to have to take a lot more risk going forward the next 12 months and comparing to the last 12 months. I would say the risk you were taking the last 12 months wasn't even on the same level, and it produced a ton of returns, a ton of reward. Going forward the next 12 months, given where we're at from these numbers and how often these corrections happen, you're going to have to accept a lot more risk in order to get the same type of reward, if not less. And that should definitely give you some type of signal to rethink how your portfolio is invested and seeing where your most conservative positions are and where your most aggressive positions are, and ultimately how that all combines into your overall portfolio strategy.
Well said, Jacob. And also we have done a research on pullbacks or equity sell-off. So which is a pullback, equity sell-off? So it's when the market declines from the peak more than 5%, no? And also, more than 5, but this is important. When the market started to decline, you don't know if the market is going to stop at 5, 10, or 15. So this is important. So based on historical information, and you have this graph from 2020, again, the Standard & Poor's 500, you have in red this pullback, after the big crash of March 2020, you have, a decline of 6%. Then you have in June of 2020 another one of 8%, and then you have the upside potential that go to a new peak. The last one was kind of big. It was September, the last one in 2020. it was around September, October, was almost 9.5. And then in this year, we have only one. That was in March. It was 5.70%. And since then, the market has grown 21%. So we analyze the historical of pullbacks, this kind of decline in the market of more than 5%. And the median gain of, from the low to the peak is 19%. So remember, in a correction was 38%. Now it's 19. And the median time that all this pullback lasts, it was around 4 months. Remember, the last one was on November, October of last year. So again, we're overdue to a pullback also, because the median time that this pullback lasts is 4 months. So this is important. You don't have to wait to see the market to fall down to 10%, because you don't know when it's going to fall down, but just use all these kind of decline to enter to the market, to use your, you have extra savings, you have some money. So just see a decline as something positive instead of something negative. This is what we want to kind of let you with these thoughts, no?
Yeah, I mean, we always hear, Pablo, when should I invest into the market, right? It's always what and when, what and when, what and when. And the what, I think, is a whole lot more simple, because in sitting down with folks, you get to understand what they're trying to accomplish, when they're trying to achieve certain goals, whether it's retirement, whatever else. And I know the one thing that we can control when you invest, and if you don't know this, it's good to hear, is your risk. And how you control your risk is by being well allocated, being diversified, being able to have complementing investments that hopefully are correlated inversely, or maybe in simple ways to put it, stocks go up, bonds typically lag, and vice versa. That doesn't always play as it theoretically would make sense to, but this is an excellent time, as we pull up this graph once again that we just looked at for the year, that we've had one pullback in March. The market has run up almost 22% since today. Overall for the year, the S&P 500 is up 20+%. So the question you have to ask yourself is there something that's going to be making more money going forward until the rest of the year? Because maybe it's not the S&P 500, right? Maybe it's something else out there, whether it's specific sectors, whether it's international. There's a ton of categories that you can look into. But the question that we would like to put front in mind to everyone is, it's a great time to reassess what that looks like, given that statistical historical data that we've looked at. There might be some opportunities that are often overlooked, especially last 18 months, that maybe are starting to show a little bit of sign of having a better risk to reward dynamic here. So we're going to take a pause here. We'll shift forward to talk about a little bit of more personal finance here. We'll stem away from the technical side of things, but please reference these charts, as it's really valuable to understand where we're at. Hopefully it drives you to make better decisions here. So we'll pause here and we will pick it up here momentarily, talk about a very important personal finance tip in order to hopefully maximize your savings, your investments, and ultimately your wealth. Welcome back, everyone. Thank you for the information, Pablo. You get the credit. You have definitely put all of that historical statistical data here. So thank you for that. The other thing that we want to transition to here, which I'll let Pablo introduce here, is more personal finance. So Pablo, take it away. What would you like to share?
So we have this graph in our research that kind of tell you which has been the age where people tend to save more out of their income. And if you can see the graph right side, so you have different age groups, and then you have the saving rate per age group. Based on the research, is the age group that has the highest saving rate is the age group from 45 to 54. which is they can save up to 15, almost 16% of their income. Then the other age group is from 35 to 40, 44, and 55 to 64. So why this is important for you is because if you are in this age group and you feel that you have not saved enough, so it's a good time to think that historically, the people who save the most are between 45 and 54. This is your time, basically, because then it started to, your earning started to decline, or you have other expenses, or basically you don't work as much as before, no? So that's the part that you have to be aware. So it's a good time to talk to a financial advisor.
Definitely.
Because they can help you to kind of monitor or at least to set up the right financial goal for retirement. They can basically tell you how much do you need or how much more you have to save. So remember, these people that they are in this age group, this is your time. There is no much time if you pass this age group from 45 to 54.
That's excellent. And I definitely, speaking to someone, whether it's us, whether it's your advisor as a whole, whoever it is, I think to have that conversation is extremely powerful, because often we find in financial planning, people are a little bit more pessimistic because of them not knowing. And they're just saving away, and they think, well, I'm behind. It's amazing how many times we get people in front of us and we reassess, we organize, and say, okay, here's how things are looking. And there's just like this big relief. They're like, wow, I didn't understand how well I'm actually doing. So we wanted to show you this chart because the natural progression in your age, and if you're feeling impatient of not being able to save as much as you want to now, hopefully this gives you a little bit of optimism to understand that there is a progression here. And sure, definitely whatever you're making, you don't want to be spending it. The good old rule of thumb is if you can save 10, 15% of your income, very likely that you'll be able to have a very comfortable retirement. Here's a little secret tip that I'd like to share with people. And budgeting has always been such a big component to gaining discipline and keeping yourself honest. We're going to bring up this chart once again, and this is observations I've seen, why people tend to save more when they're 45, 54 in that age group. Secret here, it doesn't really have to do with their income. It really has to do with discipline and having experience.
Yeah, and while you were talking, I was thinking that we are saying to, like, from outside, simple thing, save more and buy low and sell high. When it's after a correction, it's a buy low. Basically, it's easy, no? Well, we understand that it's not that easy. The psychology of our habits, kind of, we get scared when the market is coming down. So we understand that, but if you can remove all this emotion, I want this car, I want this. If we can remove all this part, basically, we have to go to the simple part. Saving more is, control your expenses and then buy low and sell high.
That's right. And this is a quick plug to not just us, but all advisors. I think the very consistent factor into that progression for people in their 20s and their 30s, oftentimes, not every time, but oftentimes, it is an advisor. It is when they actually proactively seek help, whether it is from Zenith or not, or a family member, because the emotion side of thing, as Pablo mentioned, is always a hard thing. So that's a really great takeaway here in terms of the age groups and how that progresses. It's not about how much money you make, it's about what you actually spend and therefore save and even further invest. We're going to transition here to our last topic and just discuss what to expect here for the rest of the year. Earlier in the year, we talked about studying historically what has taken place month over month. We actually also did a very specific focus research on what happens in the market the first year in every new administration's tenure, in correlation with the stock market. How does the stock market perform in the first year of a new administration? And last year, when we were looking at this research, it was very easy to identify that the months of August, September, October were by far the most volatile. So as we enter into September, as we see here that the market has been on a 20+% tear since late March of this year, we still have a little bit of reservations. We're being very observant right now to understand where the market potentially is heading for the rest of the year. But after we get through that period, the months of November, December historically tend to be extremely fruitful and a lot less volatile. Again, to bring in some of the things that we've discussed in terms of the risk to reward, assessing your portfolio right now, I'll speak for us and our clients, is it's okay to be able to rotate out of certain investments. Don't get emotional, to Pablo's point, with your investments as you see it increase. Take some gains. It's okay to take some gains and reshift into something a little bit more balanced. Pablo, I don't know if you'd like to add anything to that as we wrap up our episode for today.
Just to summarize, remember, pullbacks they're more often, they happen, they last less, but also it's a good entry point. You don't have to wait for correction. You don't have to wait. You have to always put money in the market because it's hard to time it. But always, if you have something, always, if you see a discount or decline, I won't say smile, but basically, if you have some extra money, you should put it to work. This is a good entry point.
That's excellent. And if you don't, ask yourself this in seeking to see if it is a great time to talk to a professional. Do I have enough time? Think about how many times you've rebalanced, reallocated your account this past year. Do I have the knowledge? Are we spending enough time to research, to analyze, to make sure that you're taking proper action in your portfolio as time progresses? Do I have the will, right? Some people may have the knowledge, some have the time, but we're all busy with our lives, whether it's families or profession, social life, whatever it is. So those are big 3 points to discuss internally within yourself: time, the knowledge, the will. If it's a combination of any that you aren't checking the box per se, I would say that's a very good sign to take a good step in consulting with someone. Hopefully you got good takeaways from today. We are happy that you're able to join us here for this moment for the month of September. As mentioned, please leave us some comments so that we can start to discuss things that you want to, of course. Pablo, I think this will wrap things up. Thank you for joining us. We'll catch you guys in the month of October.
Thank you very much. Take care.